Welcome back to the show. Former Federal Reserve Governor Robert Heller, appointed by Ronald Reagan quite a few years ago. Bob Heller, welcome back. A while back, I think it was back in June, you suggested there was going to be a double-dip recession. So the first half of the year was in decline. You were right. The second half of the year looks to be slightly positive. And you think next year is going to be a recession to complete the double dip. Is that the idea?
I fully agree with what you just said, and good to be here again, Larry. 85% of all CEOs in a recent survey say that they expected recession next year, and that would make the double dip complete.
You know, we've got a chart put up on the full screen, Robert. I don't know if you can see it. M2, the growth rate of M2 has basically collapsed from close to 30% all the way down to near zero. And I want to add to that, the New York Fed model, the 3-month Treasury bill is now higher than the 10-year bond. That's a recession signal. And the index of leading indicators is also crashing, Bob Heller. It's got recession all over it.
Well, I agree with those numbers. And the money supply is something that I carefully watch. The Federal Reserve, unfortunately, doesn't watch it at all anymore. And the money supply shows that the past exuberance is over. When the money supply was growing at 25% in 2020, 2021, those days are over. And therefore, the good news is that inflation will also come down as we get into the recession.
How much danger is there, Bob Heller, that the Fed will overdo it?
Well, there's always that danger, but so far they are not overdoing it. I would say that interest rates right now are not restrictive yet. They're roughly neutral as far as the Fed funds rate is concerned. And that's the instrument that the Federal Reserve uses right now to steer the economy. So they may even have a little bit more ways to go on the Fed funds rate, tightening further to achieve their goal. And their goal of 2% inflation is a little far in the future. I mean, we're running right now at an inflation rate of 7.7%. That's almost 4 times the rate at which they want to be. They got a long way to go.
I don't want to get too far in the weeds, but, you know, that old New York Fed model where the 3-month Treasury bill versus the 10-year Treasury bond note, whenever that bill rate is higher than the bond rate, so right now the bill is about 4.25, the bond is about 3.80. Within a year, there's a recession. I mean, that thing is almost infallible. I think people have forgotten about that model, but I want to give you a chance to talk about it because it's got recession all over it.
I agree with you, and it means that the long-term expectations of inflation are going down, and what triggers that is clearly the recession. So as we get into the recession sometime in the middle of the year, inflation rates will go down, and that's why the 10-year rate is lower than the short-term rate.
Yeah. And the leading indicators, another old-fashioned lost indicator, but the growth rate is down, I think, -4%. So it doesn't look great. Your double-dip recession, you said it months ago, may turn out to be a great call, Bob Heller. Thank you very much. We'll talk some more about this over time.
Thank you.